Good morning, ladies and gentlemen, and welcome to Cepsa first half 2020 results presentation. My name is Salvador Bonacasa, CFO, and I will be conducting the presentation today. I am joined by my colleagues Paloma Luzárraga and Gonzalo Sainz, and Gonzalo will make a brief introduction.
Thank you very much, Salvador, and good morning, ladies and gentlemen. This is Gonzalo Sainz, Cepsa Head of Finance. So, before we begin, please let me take a moment to flag that financial information contained in this document is unaudited and certain figures are non-IFRS. This webcast, including the Q&A session, may contain forward-looking statements. These statements reflect the company's beliefs, intentions, and correct expectations concerning, among other things, the company's results of operations, financial condition, liquidity, prospects, growth, and strategies. Forward-looking statements are not guaranteeing of future performance of the company. Please take a moment to read the disclaimer on the first page of the presentation. During the presentation, you can send us your questions through Slido. To do so, please go to slido.com and enter the passcode shown on screen, Cepsa Results. You may post your questions at any time during the presentation, and we will address them at the end of the session. I kindly ask you to please identify yourself when posting your questions so that we may refer to you when providing answers. So without further delay, over to you, Salvador. The floor is yours.
Thank you. Thank you very much, Gonzalo. Good morning again, ladies and gentlemen, and thank you for joining us today, Cepsa first half results presentation. This is Salvador Bonacasa, CFO for the group, and it gives me a great pleasure to present with you for the first time our first half 2020 results. First and foremost, we hope that you and your family, friends and colleagues are in good health and given the current situation. In today's presentation, I will be taking you through some key highlights of the first half of the year and provide you with some reflection on what has been a quite challenging environment with a situation with no precedent in recent times, which has affected all companies in virtually all sectors. So we pass through the page number 5, I think. Thank you, Gonzalo. Let's start our presentation with our highlights for the half of the year. During these first months of the year, crude price and global demand for oil and oil products has been severely impacted by the spread of the COVID-19. Our clear priority in this situation since the start of the crisis has been to protect the health and safety of our employees, clients and suppliers, while ensuring the continuity of our operations, to guarantee the supply of essential energy products and services to society. The decrease in crude oil prices caused by COVID-19 has impacted the company's inventory valuation, resulting in a non-cash effect of minus €464 million. In addition, Cepsa revised its long-term price forecast, which triggered non-cash assets impairments of upstream division of €331 million. In terms of financial performance, and despite this challenging market environment, Cepsa generated a positive operating cash flow of €439 million, with all of our four business units generating positive cash flow in the period. In response to the deteriorating market and economic condition, Cepsa put in place a contingency plan with a range of actions aimed to protecting cash flow generation for the year. This plan initially provided cost savings amounting to €310 million, has been now revised upwards to €500 million. Out of these €500 million, €275 in savings have been already captured as of June. In addition, during the second quarter, Cepsa has focused on reinforcing its liquidity position and on the extension of debt maturities. We will go in further details later in this presentation. Finally, in terms of corporate events, in May, Cepsa launched a new organization to address the challenges of the energy transition with the aim of internalizing of the businesses and strengthening the integrated business model. Such new organization is managed by a team composed of both newly hired executives alongside seasoned company professionals with extensive international experience in the oil and gas and chemical industries. Also, it's worth highlighting that all three rating agencies affirmed Cepsa investment-grade credit ratings post-COVID situation. Moving to the next slide. Thank you, Gonzalo. We would like to comment the COVID-19 impact on overall Cepsa performance and on each business unit specifically. I would like to start by saying that thanks to the dedication and professionalism of all our employees, the supply of energy products and services to our customers and society at large has been a priority and has been guaranteed at all times. During these extraordinary circumstances, Cepsa has maintained its industrial facilities operational and has continued to fulfill its role as an essential industry. With respect to the COVID-19 in each of our businesses, I would like to highlight the following points. In upstream, has had a limited operational impact to date, apart from the decrease in production levels, driven by OPEC quota restriction affecting our operations mainly in Algeria and the United Arab Emirates. Crude prices have recovered post-OPEC deal and as economies are recovering. Refining, in a very challenging market environment, Cepsa refining businesses has demonstrated operational flexibility and the ability to optimize production in order to ensure the supply of energy products to the domestic market, both Spanish and Portugal. The businesses has seen a weaker refinery market environment in the quarter due to the impact of COVID-19, being refinery runs adjusted to market circumstances, with an average utilization of 74%. However, by the end of the quarter, refineries were already running at 82% utilization and are expected to increase to up to 85% during the month of July, progressively to full utilization by year-end, assuming, of course, the positive trend in demand continue. In marketing, during this second quarter of 2020, demand for oil products has been hit by the pandemic and the subsequent lockdowns in Spain, with automotive volumes falling as much as 60% in April versus April 19. However, along the quarter, volumes have been gradually improving, with 2/3 of the volume decline recovered in June, and all the service extensions were already operational. Lastly, in chemicals, COVID-19 pandemic has had a positive impact, mainly in the LAB, linear alkyl benzene segment, as LAB is a raw material for detergents which are currently in high demand. Plants have been operating at full capacity through the period. If we pass to the... Thank you. In this slide, we try to show you our contingency plan. With the deterioration of the macroeconomic outlook during the month of March, Cepsa put in place a contingency plan comprising several initiatives totaling 500 million euros in savings for the whole year, with the aim to protect cash flow generation for the year and strengthen its balance sheet. These initiatives can be divided into operational and financial ones. In terms of operational initiatives, we target OPEX savings of 120 million euros across all business units and operations. Savings in capital investments projects totaling 380 million euros. At this point, it's very important to mention that of these 500 million euros in total savings, 275 million euros have been already captured as of June. In addition, taking advantage of the historically low prices, we hedge a relevant portions, close to 50%, of the 2020 energy cost for our industrial plants. And we have used available storage capacity to profit from crude contango trades. Finally, we continue to work on optimization opportunities of the company's working capital. On the other hand, in terms of financial initiatives, I would like to highlight the company's efforts to further improve its liquidity position during the year, given the extraordinary circumstances. In this sense, Cepsa has executed new committed banking facilities for a total amount of 1.2 billion euros during this period. And it has accessed the debt capital market twice, with two 500 million euros bond issues, which achieved, both of them, large oversubscriptions, having, at the end of June, total liquidity of 4.5 billion euros pro forma for the last bond issue in July, providing a sound, flexible financing autonomy to cope with the most adverse trading conditions and to support the business going forward. Now, please, let's move to the slide number 8 of the new organization. As shown in this chart, Cepsa has a new organization in place, which has come into effect on June the 1st. The new organization is managed by a team composed of 3 newly hired executives who will run the upstream, marketing, and chemical businesses, alongside seasoned company professionals with extensive international experience in the oil, gas, and chemical sectors. The new management team, led by CEO Philippe Boisseau, will shape a strategy based on international expansion and the development of new businesses that will drive Cepsa's transformation and growth in the context of a continually evolving energy landscape and market environment. It is worth highlighting that a new ESG cross-functional division reporting directly to the company CEO has been created, which is already working to define specific short and long-term targets in these fields. Moving on to the slide 9, you may see the evolution of the main external variables that affect our businesses: crude oil price, refining margins, euro-dollar exchange rate, and fuel demand in Spain. As a sign of what has been the market environment during the second quarter is that both crude oil prices and refining margins have registered their minimum levels, with average values of $18 per barrel in April, in the case of crude, and $0.7 per barrel in May, in the case of the Cepsa refining margin. Although average crude oil price have been low during the second quarter, we have observed an improvement from April to June, thanks to the OPEC agreement to extend its supply cuts into July, coupled with the positive effects of positive macroeconomic data and the stimulus measures put in place by central banks and governments. Refinery margins are also experiencing a soft recovery from their minimum levels in May. As per the euro-dollar exchange rate, as you can see in the graph just on the bottom left side, during the first half of the year, we have seen the US dollar gradually appreciating versus the euro, acting as safe haven given the challenging market environment. More recently, however, especially after the approval of the European Commission of the stimulus plan of 750 billion euros, and as a result of the negative news coming from the USA and the spike in COVID-19 cases, the euro has regained momentum and is currently trading at approximately 1.17. Finally, as already mentioned several times, demand for oil products has been severely affected by the COVID-19 pandemic, with automotive fuels demand in Spain falling by more than 60% in the month of April versus the same month of 2019. However, volumes have been progressively improving along the quarter, with June volumes already at 80%, more or less, versus the same period of 2019. As we move into the months of July and August, and the holding period starts, we expect volumes to continue gradually improving. In the slide number 10, we wanted to share with you some key highlights of the results for the first half of 2020. Despite the impact of the COVID-19, which has been particularly acute during the second quarter of 2020, cost savings put in place on our integrated business model has proven its strong resilience in these very difficult circumstances. As such, Clean CCS EBITDA during the first half of the year was 633 million euros, decreasing by a 37% versus 19. Clean CCS net income has registered a strong decrease, primarily resulting from low crude oil prices, the low refining market environment, and the decrease in the demand due to the pandemic. Cash flow from operating activities was 439 million euros, with all four businesses generating positive cash during the period. Investments, on the other hand, have decreased by 20% year-on-year comparison, as a result of the contingency plan put in place to preserve cash flow generation for the company. As per the main balance sheet figures, as you can see in the bottom of the page, net debt has been increased somewhat, with net leverage increasing to 2.0 multiplier, mainly as a result of the decrease in EBITDA. Sorry. A strong liquidity position of 4.5 billion euros, an increase of 45% versus June 19, driven by the new credit facilities and bond issues performed as previously discussed. If we pass to the slide 11, thank you. I'm focusing now on the group operating performance. Working interest production in the E&P division was 80,000 barrels per day, compared to 94 in June 19, due to the OPEC quota restriction affecting both Algeria and Abu Dhabi, already mentioned. Realized crude price in the first half was, in average, $40 per barrel, affected by the COVID pandemic also. A slight increase in upstream OPEX from 9.7 to 10.3 per barrel, due to the slight different mix in production as a result of the OPEC quotas. In refining, Cepsa refining margin stood at $3.6 per barrel versus $3.9 during the first half of 2019, as a result of the decrease in the demand for oil products due to the COVID-19, which led the narrower middle distillate and gasoline crack spreads and light to heavy crude oil spreads also. Utilization rates at the refineries were reduced to an average of 81% during the first half, adapting to the decrease in demand during this period. Marketing product sales decreased due to the lockdown, but the gradual reopening of the Spanish economy in May, and more importantly in June, resulted in increased volumes towards the end of the quarter. Finally, in chemicals, product sales has been equal to those of 2019, and as increasing the demand in the LAB segment has been offset by the decrease in the phenol and acetone and solvent segments. The resilient nature and strong performance of these businesses has partially offset lower earnings in other business units. In the page number 12, we might review the short-term market outlook. Firstly, it is worthwhile highlighting that for the second half of the year, we are cautiously optimistic about an improved market outlook supported by an economic recovery following the lifting of lockdown measures around the world and a more stable commodity price environment. In our home market of Iberia, we are already seeing positive signs of such recovery, with automotive fuels demand increasing month by month since May. A further commentary on the individual business segments. In upstream, we expect oil price to remain stable in the near term. Production is expected to gradually recover as OPEC restrictions are lifted in synchronicity with the market recovery. In refining, margin are expected to remain volatile in the near term, with refinery utilization expected to increase as economies will be reopened. In marketing, as mentioned before, volumes has been depressed in Q2, but as the Spanish economy has reopened, we have seen a strong recovery in volumes in this period. Margins are expected to remain healthy for the second half. Finally, in chemicals, we expect the strong performance to continue, especially in the LAB segment, with stable margins in the near term. Well, just now we are going to proceed in order to explain something about the results for the first half. And in the slide number 14, we take a look in more details at EBITDA figures by business unit. As previously mentioned, EBITDA has been affected by the challenging market condition caused by COVID-19, especially in the second quarter. By business unit, Upstream registered an EBITDA of 227 million euros, down 53% year-on-year basis, driven by lower realized crude price, 58 in comparison year-to-year, and lower production, minus 20%, due to OPEC quota restrictions affecting both Algeria and Abu Dhabi. At free cash flow level, however, Upstream is less affected due to reduced taxes according to the reduction in the revenues of the business. This business accounts for 37% of the group EBITDA as of June 2020. In refining, registered 84 million euros of EBITDA during the first 6 months, down 57% year-on-year, due to a weaker refining margin environment and lower production, as we mentioned before. This decrease in refinery runs is because we have been adapted to market demand, trying to optimize margins in the very short term. Refining accounted for 13% of group EBITDA in the first half of 2020. Marketing EBITDA was down 18% on a yearly basis to 176 million euros, driven by lower demand following the lockdown in Spain in the second quarter. Gradual reopening of the Spanish economy resulted in increased volumes towards the end of the quarter. Marketing accounted for 28% of group's EBITDA in the first half of 2020. Chemicals registered an EBITDA of 165 million euros, up 32% year-on-year, mainly as a result of the strong performance of the LAB system, as previously mentioned. Chemicals accounted for 26% of group's EBITDA. Corporation costs were down 25% year-on-year basis as a result of cost savings linked to the contingency plan put in place. In the slide number 15, we are going to comment something about the cash flow generation. During the first half of 2020, cash flow from operation before the working capital stood at 439 million euros, with all 4 businesses generating positive cash flow during the period. Despite the decrease in crude oil and oil product prices, we had a negative working capital impact of 243 million euros, mainly related to a higher level of crude payments versus fourth quarter in 2019, in which these were abnormally low. We are focusing on optimizing the company working capital and expect to see a cash release later in this year. CapEx for the first half of the year amounted 432 million euros, with main investment being the development of upstream assets in Abu Dhabi, a number of projects in the refining and chemicals plants aimed at improving efficiency, as well as the acquisition of a 40% stake in 2 asphalt companies, bitumen companies in Morocco. As you may see, most investments are related to growth and efficiency projects, which account approximately to 70% of total CapEx. With all the above, Free cash flow for the period stood at negative 350 million euros, driven by lower results, the negative working capital effect mentioned earlier, and growth investments. Let's move now to the slide number 16 to discuss about our capital structure. Cepsa maintains a robust balance sheet, as you can see in the slide, with net debt of 3.1 billion euros as of 13 of June of 2020, and a net debt to EBITDA ratio of 2 times. Following the onset of COVID-19, and especially during the second quarter, Cepsa has focused on reinforcing its liquidity position and terming out a number of its short-term facilities. In this sense, Cepsa has carried out a number of actions such as the renewal and extension of existing short-term credit lines in excess of 580 million euros, the signing of new committed banking facilities for a total amount of 800 million euros, and the extension of its 2 billion syndicates RCF by 1 year until 2026, executing a one-year extension option which was unanimously approved by all 19 banks. As a result, as of the end of June, Cepsa holds a strong liquidity position comprised of cash on balance sheet and available committed credit facilities in excess of 4.5 billion euros. Pro forma for the bond of 500 million euros issued in July. And Cepsa has also a high average debt tenor of 4.3 years. The slide 17, let's look at our debt maturity profile. Here, I would like to flag the following points. With the maturity extension executed during the second quarter, mentioned earlier, and the 8-year bond issued in early February, the average maturity of the debt currently stands at 4.3 years. It is worth noting that Cepsa has accessed the debt capital market 3 times in just over a year, with 3 500 million bond issuance, the last one executed in early July, which has allowed the company to extend its debt maturities up to the 4.3 years mentioned before. We hold a strong cash position, which as 13 of June stood at 1.9 billion euros, and a total liquidity understood as cash plus available committed facilities of 4.5 billion euros, considering the last bond issue done in early July. In the coming quarters, we will continue to work on refinancing and extending further the company's short-term debt maturities. Finally, some words on the ratings on page 18. As you may see in this slide, Cepsa's investment grade credit ratings have been affirmed post-COVID by all 3 rating agencies. Both Fitch and Moody's confirmed Cepsa's ratings in April at BBB- and Baa3 respectively. Moody's negative outlook reflects the agency concerns in the sector in general as a result of the decrease in crude oil prices and the COVID-19 pandemic, and is not, I think, a company-specific issue. More recently, during the month of June, Standard & Poor's confirmed Cepsa BBB- rating with a stable outlook. In addition, I would like to emphasize that for both Cepsa and its shareholders, maintaining investment grade ratings is a key priority, and to that end, we will continue observing conservative financial policies. And well, with this slide, we conclude today's presentation. But before moving to question and answer, I would like to say that we believe that the worst part of the COVID-19 pandemic is probably behind us, and that assuming that the positive trend in demand seen in the months of June and July continues in the next future, we expect a somewhat better second half of the year. In addition, from a financial point of view, we have significantly strengthened the liquidity position of the company, and therefore believe we are well prepared to face the future with increased confidence. Our integrated business model has proven to be solid and strongly resilient in these unprecedented circumstances. For further details on Cepsa results, I encourage you to refer to the press release and quarterly report, which will be published on Cepsa's website right after this call. Thank you very much for your attention.
Okay, thank you very much, Salvador. We will now move to the Q&A. So please let me remind you once again how you may direct us your questions. You may go to slido.com and enter the passcode showed on screen, Cepsa results. Once on the event page, you may type your questions in the dialog box. I kindly ask you to please identify yourself so that we may refer to you when posting answers. Many thanks. Okay, so it looks like we have a couple of questions already. The first one, Salvador, you mentioned that the new management team is working on a new strategy. Could you please give us some more details on this?
Well, at this point in time, just in July, I am afraid I cannot provide you too much detail since we are currently in the process of defining the new strategy for the company. However, what I can say is that it will be based on the development of new businesses to address the challenges of the energy transition, the international expansion, and the strengthening of our integrated business model. In this sense, renewable power generation will most likely to be one of the company growth pillars going forward. But the strategy will be ended at the end of this year, and after that we can comment more in detail.
Okay, thank you very much. And the second question is regarding free cash flow guidance for 2020, whether we could give any guidance on that, on how we expect free cash flow generation for the year.
The free cash flow generation. Yeah. Well, as you can imagine, it's very difficult to predict what the free cash flow generation will be at the end of the year. But, since it will depend on how the second half of the year develops and the pace of the recovery in demand, mainly in Spain and Portugal, but for the whole global economy. Having said that, however, we aim to achieve cash flow neutrality before dividend payments with the overriding objective to preserving investment grade ratings at the end of the year. Probably, in a few words, we are going to take measures in order to achieve this cash flow neutrality for 2020.
Okay, thank you very much. So it looks like we have no further questions at this point. So I guess with this, we conclude today's presentation. Thank you very much, ladies and gentlemen, for joining us. And as Salvador mentioned, you may go to our website for further details on results presentation. We will be posting a quarterly report and the press release shortly. Thank you very much.